Hello, welcome to Queen's University Actuarial Consultancy presentation. I'm just going to take you through the main points that are in your evaluation report. As you can see in front of you, it'll be a short presentation, about 10 minutes long, and you'll all have an opportunity to ask questions at the end. I'm James O'Hare. I was involved in the main superval run and calculating the liabilities. Emer Murphy put together your evaluation report. Fiona done all the checks. Jennifer's going to be taking you through the most of this presentation, and Brendan done a bit of the sensitivity analysis, which I'll be taking you through as well. First of all, the assumptions. We got our inflation assumption through annual RPI figures from 1996 onwards. We took them from 1996 as we felt this was the best representation of inflation over the last 50 years, because that was the year that the Bank of England was nationalised. Furthermore, we got salary growth. Salary growth was 3.5%, it's just usually slightly higher than inflation, so we just rounded it up to 3.5%. Our interest rates pre-retirement was calculated as 7.48%. This was taken through adding a risk premium to the long-term gilt rate, which is considered to be virtually risk-free. The long-term gilt rate was about 4.5, 4.6%. We just added our inflation figure onto that, and as a post-retirement interest rate, we took it to be 6.48%. We just got it by subtracting 1% from our pre-retirement rate, as generally the return in post-retirement is slightly less due to the investment strategies in both. Mortality tables we used with PMA 92 tables. We rated them -3 just due to the improvements in healthcare that have been made over the years. And just to take note of the healthcare changes since 1992, just so that our reported liability was fair and accurate. The proportion married of males and females was both taken to be 90%. Take you through, in the pension plan we had 968 members. These were split into 3 categories between active, deferred and pensioners, as you can see through the pie chart there. Pensioners was 26%, and these were being funded through our active members was 36%, and deferreds was 38%. Deferreds are just people who have left the company but still need to claim a pension for the years that they have done prior to leaving the company, and they claim their pension then whenever they hit the retirement age of 65. As you can see, it's a pretty even balance between the 3 categories there. Each member was assigned to a different category, one of 5 different categories according to the pension increases. The first category, there was no increases pre and post 97, and the second was basically our main category. As you can see through the bar chart here, that was where most of our active and deferred members were placed into, and in this category there was no increases from pre-97, and then our increase was just our inflation figure then post 1997. Groups 3, 4 and 5, they were evenly distributed through all members, and this was taken through either a 4% figure or inflation figure. There was a balance between the 2 of them. I'll take you now through the calculations that we made. Firstly, as our assets, we have £75 million based in equities. This is subject to change as well. We know that that's a very high risk strategy, but Jennifer will be taking me through that there in the later stages of the presentation, and how we like to balance our assets more evenly. Our liabilities, our main liabilities was our active members. There are 58 million, and our total came out at 107 million, which gave us a deficit of 33 million and a funding level of 70%. Now, obviously, that leaves us in quite a bit of trouble, and we want to analyse ways of rectifying that and bringing the funding level up to 100%. Just to let you know that it's not really, although it is a concern, it's a concern that lots of companies have throughout the world at the minute. As you can see from our comparison, the average deficit, and there you have the FTSE 100 index, is just over 500 million for their pension plan. So a lot of companies are facing difficulties at the minute, and as I said, we will be discussing ways that we can increase this funding level back to 100%. Finally, I'll just take you through the sensitivity analysis involved in the presentation. This is just basically how sensitive our liabilities are to the different assumptions that we've made. I'll take you through the three main assumptions that we've made in interest rates, salary growth and inflation. As you can see, our interest rate figure, when we decrease our interest rates by 1%, there's a 17% change in our total liabilities and a 20% change roughly the other way of looking. Now, although this is worrying, interest rates are low at the minute, and our expectation would be they might actually be lower than our assumptions. We were quite prudent when we were making our assumptions, and if it was to be 1% lower, that would see our funding level rise actually by 15% to 85%. Salary growth there, we changed it by 0.5% either side, and it wasn't quite as sensitive as our interest rate changes. You can see there are 5 and 6% change, 5 million and 6 million respectively. Finally, I'll take you through our inflation. We changed our inflation figure using the consumer price index instead of the retail price index, and this caused a change of 5 million, so that was just less than 5% as well. So really the variable that is our key variable that is sensitive, or that is very sensitive to our assumptions, is really our interest rates. The other variables seem to be quite robust whenever we were carrying out our sensitivity analysis. I'll now hand you over to Jennifer, who will take you through the closing stages of the presentation.
Thank you, James. So, taking our current assumptions into account, as James has already mentioned, the scheme has liabilities of 107 million. So to reduce the liabilities and boost funding, we have investigated some cost-saving areas. Adjusting the accrual rate to 80th from 60th, the benefit accrued for active members would be 75%, so that would reduce the liabilities from 58 to 44 million for actives. If we change to 0% increases on further payments, and this process would involve the separate calculation of pre and post 97 pensions, and that would depend on whether the pensioner was currently in receipt of 0%, 3% or 4% increases overall. The liabilities would decrease by 25 million, and this amounts to the biggest cost saving that we're going to see. If we change to a car scheme, the further future services would decrease from 86 to 85.5 million, so we're not going to get a big cost saving in that case. The trend in many countries today is to raise the national retirement age, and this has been recently seen in France. So if the government was to follow this trend and change the national retirement age to 70, this would see a cost saving of around 13 million. If we change our inflation assumption to our CPI assumption, this would give a cost saving of just over 4 million. So our asset summary now. The scheme's current assets amount to a market value of 75 million, but these assets are wholly invested in equities. And this is an extremely volatile form of security. Fluctuating economic factors and rates would cause fluctuating stock prices, and this could see the value of equity fall significantly. Fluctuation in the value of assets results and yields in variation in funding levels. So it is advisable to spread investment among different assets. The asset allocation that you can see up on the screen suggests 30% gilts, 20% corporate bonds, 40% domestic equities and 10% other. To keep the risk portfolio diversified, a mixture of equities and bonds has been recommended, giving the scheme a stronger position to boost asset performance in challenging economic conditions. So just to conclude, as we said, for liabilities of 107 million with a deficit of 33 million under the current funding level of 70%. But there are improvements to be made. The cost savings investigated should bring funding to 100%. If the recommendations for asset allocation are followed, less risk and a more stable asset value should result. Our sensitivity analysis leads us to believe the scheme can be fully funded within the next 10 years. So.
Any questions, please fire away.